Welcome to Counters. In this lesson, we're going to be looking at the dividend growth model. We're going to focus on non-constant or supernormal or multi-stage growth. So these names are usually used interchangeably. In our previous lesson, we looked at the dividend growth model, but we focused on constant growth, where dividends were growing at a constant rate forever. That would be a good place to start if you do not know how to do that calculation. So you'll find the link to that lesson in the description below. Otherwise, you can click at the link at the top right of the screen to go to that one. And at the end of that lesson, you will be led back to this one. So what did we say the dividend growth model is? Well, we're not going to go into much theory here because we went into the theory in the other lesson, but we say that this is a method that is used to value the stock or the share price of a company. So let's get into it. What is the formula that we use for the dividend growth model? We use what we call the Gordon growth formula. And what is this? Well, this is where we have the P0 equals to the D1 divided by KE minus G. And by D1, how do we get D1? Well, D1 is D0 1 plus G. And what do these letters stand for? Well, P0 stands for the current market price, and that is what we are trying to calculate, the P0 here, the current market price, and we get it by taking D1. So what do we mean by D? Well, D0 is the current dividend, okay? D0 is the current dividend. So D1 is obviously the dividend in period 1, and that is how we get D1. We take D0, which is the current dividend, as you have seen here, times 1 plus G. And once we gotten D1, we divide it by KE minus G. And what does KE stand for? KE is the shareholder's cost of capital. In other words, this is the required rate of return, the return that the shareholders require for investing in the shares of the business. Okay, so that was what KE stands for. It's the percentage that they require. And then what does G stand for? G is the expected annual growth in dividend payments. The expected annual growth in dividend payments. Now that we know what all these letters stand for, it's going to be easier for us when we're doing the examples. Just take note of that. KE might sometimes be written as RE, so they can be used interchangeably. So your formula might have RE instead of KE, so it just means the same thing. So let's get into it in much detail. The non-constant growth. What is this? Well, this model assumes the two stages of dividend growth exists. At least two stages of dividend growth exists. So the first stage with a high growth rate for n years, which is the supernormal period. So you have a first stage where the dividends are growing at a very high rate for a number of years, and this is called the supernormal period. Okay, this assumes that perhaps the business is a new business and it's growing very quickly, and they're able to issue an increasing level of dividends, and this increase is high. Okay, so that is the first stage. And the second stage is where you have a constant growth rate forever. That is the normal period. So usually the first stage is where you have a high interest rate for a number of years, and then that interest rate falls and then it stays constant forever. That is what is assumed using the non-constant growth model. Okay, so you have to know that. And the stages might be more than two. You might have three stages where the first stage, for instance, so let me give you an example. You might be told that the dividends are growing at 30% for the next 4 years, and then it drops to 20% for another 2 years, and then it drops flat after those 2 years and remains constant forever. Or you may be given a very popular one is where your question will have two stages. The first stage is where it's growing at, let's say, 30% for the next 3 years, and then after 3 years it falls to 15% forever. Okay, so this is what the constant growth or the supernormal or multi-stage growth assumes. So what are the steps that we take when we are calculating the current market price per share? The steps to follow in calculating the price of a share using non-constant growth model are: the first one that you do is to calculate the expected dividends for all the years with high growth. And we're talking about the supernormal period. Okay, so if I give you an example to say that the dividends of a company will be growing at 30% for the next 4 years, after which it will fall to 20% forever. Okay, so what does it mean? The first step is to calculate what the dividends will be for each year up to the fourth year. Okay, the supernormal period. Okay, so we calculate the expected dividends for all the years with high growth. And the second step is to calculate the market price per share for the final year of the high growth, the supernormal period. Okay, so firstly, let's say the supernormal growth is for 4 years. So let's say they say that dividends will grow at 30% for 4 years, after which it will fall to 15% forever. The first thing is to calculate the dividends from year 1 to year 4. Once we have done that, we calculate the expected market price per share at year 4. Remember, using the formulas that we just mentioned in the previous slide. And then the third thing that we do is to discount all the future cash flows using the required rate of return to find the present value. Okay, so we're going to use the return that the shareholders want to discount all the future cash flows to today. Remember, the first step, you would have calculated the expected dividends for all the years. So you'll discount all those dividends from year 1 to year 4, discount them to year 0, and then you also discount the market price for the final year of the high growth to year 0. Okay, so we are discounting all the cash flows that we will have calculated in step 1 and step 2. And once you have done that, you will add up all the discounted cash flows to get the current market price per share. Okay, if it sounds a bit confusing or too much information, we're going to do two examples here, which will help you greatly understand this topic. So let's get into the example. We are told that Pamgo Capital's ordinary share has just paid a dividend of 6 Rand per share, which is expected to grow at 18% in the first 3 years, and from the fourth year, the growth will be 7% per year forever. The share has a required return of 20%. What is the price investors would be willing to pay for the share? Okay, so we have all the information that we need to calculate the price that investors would be willing to pay for the share, or the current market price of a share. Okay, so let's look at our formulas again. Here are our formulas. P0, which is the current market price per share, which we are trying to calculate, equals to D1 divided by KE minus G. Okay, so this is the formula that we use when you had constant growth. So it was very easy. We just used this formula to get it. But here, remember, we have non-constant growth. So we have to take that into account. And how do we get D1? So this D1 over here, we take D0, that is current dividend, 1 plus the growth rate. Okay, that's G here, the growth rate is what you are given, and the KE here is the cost of capital. Okay, so now let's follow the steps that we just highlighted in the previous slide. What is the first thing? We have to calculate the dividends from year 1 to year 3. Remember, we have to calculate the dividends for all the years in the supernormal period, and we are told that it's for the first 3 years, right? It's expected to grow at 18% in the first 3 years. So we have to calculate the dividends from year 1 to year 3. Okay, and then after we've done that, we have to calculate the market price per share at year 3. Okay, and then we'll discount them to year 0 and then add them together, and we get the current market price of a share. So the first thing, let's calculate the dividend at year 1. How do we get it? Well, here's the formula. Dividend at year 1 is dividend at year 0. That is the current dividend, 1 plus the growth rate. Okay, so dividend at year 1 will be the dividend at year 0, which is the 6 Rand, because we are told that it has just paid a dividend of 6 Rand per share. So D0 is 6 Rand, and then 1 plus G. What is G? G is the growth rate, and we are given it's 18%. So we usually put all our percentages as a decimal. If you want to get the decimal, you just take the percentage divided by 100. So in this case, we take 18 divided by 100. It's going to give us 0.18. So it's going to be 1 plus 0.18, the growth rate in the supernormal period. So let's do D1. D1 is the 6 Rand times 1 plus 0.18, and it gives us 7 Rand 8 cents. Now that is the dividend at period 1. Okay. Now, how do we get the dividend at period 2? Well, we take dividend at period 1 times 1 plus G. Okay, so we'll take this dividend that we have just calculated at period 1, and then we'll multiply it by 1 plus the growth rate. Okay, just like we did for period 1, we took the one at year 0 at the previous period times 1 plus the growth rate. So for D2, or for period 2, we will take the one for the previous period, which would be D1, and here it is, 7 Rand 8 cents, which is the dividend at period 1, times 1 plus 0.18, and it gives us the dividend of at period 2 of 8 Rand 35 cents. Okay, now we need to get the dividend at period 3. Remember, period 3, remember that is where the supernormal growth ends, at period 3. So we're going to take the dividend at period 2, which is the 8 rand 35 cents times 1 plus 0.18, and here we have it, 8 rand 35 cents times 1 plus 0.18, and it gives us a dividend at period 3 of 9 rand 86 cents. Now we have all the dividends for period 1 to period 3, which is the supernormal period. Remember, it ends at period 3 because we are told that it's in the first 3 years, and then from year 4 the growth will be 7%. Okay, so what is the next step? So we've done the first step. The second step is to calculate the market price per share at period 3. Okay, and how do we do that? Now, if you can see this formula here, market price per share at year 0 is D1 divided by KE, which is the required rate of return, minus the growth rate. So I want you to focus on D1 here. If I want to get the market price per share at period 0, I will take D1. What do we want? We want the market price per share at period 3, at the last year of the supernormal period. Okay, so it is year 3. So for me to get P3, I will need D4. Remember, for me to get the market price of a share, I will need the dividend for the following period. Okay, so I want the market price per share at year 3, so I will need the dividend at period 4, and then I will divide it by the required rate of return minus the growth rate. And here is how it looks. Market price per share at period 3 equals to dividend at period 4, okay, divided by the required rate of return minus the growth rate. Okay, so for me to get the market price per share at period 3, I will need D4. And how will I calculate D4? The exact same way we've been calculating D1, D2, and D3. So for D4, I will take a D3 times 1 plus the growth rate. And remember, the growth rate is no longer 18%. Remember, from period 4 onwards, it will fall to 7% forever. Okay, 7% per year forever. So let's get D4. Well, D4 equals D3, which is the dividend at period 3, which is this 9 rand 86 cents, and then 1 plus the growth rate of 7%. So 7 divided by 100 is 0.07. So we put it in decimal form. And here it is, 9 rand 86 cents, which is the dividend at period 3 over here, times 1 plus 0.07, and it will give us dividend at period 4 of 10 rand 55 cents. Now that we have the dividend at period 4, we just need to divide that answer by the required rate of return of 20%. That one doesn't change, so it's going to be divided by 0.2. Remember, 20 divided by 100 is 0.2 minus the 0.07. Okay, the new growth rate during the normal period. So here we have it, 10 rand 55 cents divided by 0.2 minus 0.07, and we get the market price per share at period 3 of 81 rand 16 cents. Okay, I hope you're following along well and you're understanding the process we're going through. Okay, so we have done the first step of calculating the dividends during the supernormal period, which is the dividend at year 1, year 2, year 3. Then we have done the second step of calculating the market price per share at period 3, which is the final year of the supernormal period. Okay, and then we have gotten the answer here, 81 rand 16 cents. Now we need to do the third step of discounting the dividend at period 1, dividend at period 2, dividend at period 3, including the market price per share at period 3 to today's value. Okay, so we need, that's the third step that we're going to do. So when you're discounting these cash flows, what will you do? You will take the cash flow that you want to discount divided by 1 plus the required rate of return, which is the KE, to the power of the year that you want to discount. Okay, so here it is. If you want to get the cash flow today, that means discounting it to today. You'll take the cash flow you want to discount divided by 1 plus the KE, which is the required rate of return, to the power of the year you are discounting. Okay, let's see how we do that. So let's first discount the dividend at period 1. What are we going to do? We're going to take that cash flow, which is the cash flow we're talking about here, which is the 7 rand 8 cents. Okay, and then I divide that by 1 plus the KE, which is the required rate of return of 20%. Remember, I'll put it in decimal. 20 divided by 100 is 0.2. So it's 7 rand 8 cents, which is the cash flow, divided by 1 plus KE, which is the 0.20, to the power of the year I am discounting. What year is it? Well, it's dividend at year 1. Okay, so if it's to the power of 1, I don't even have to put that I don't have to raise it by 1 because I'm still going to give me the same answer. So here it is, D1 which is the discounted cash flow, is the 7 rand 8 cents, which we got when we calculated the dividend at period 1, divided by 1 plus 0.2, which is the KE, the required rate of return. I didn't have to put to the power of 1, because even if you put it to the power of 1, it will not change what the answer will be. And it gives me a discounted dividend of 5 rand 90 cents. So dividend 1 is equal to 5 rand 90 cents today. Okay, that is what it's worth today. How will we discount the dividend at period 2? Well, we are going to take the 8 rand 35 cents divided by 1 plus 0.2 to the power of 2, because I'm in year 2. Okay, so there we go. 8 rand 35 cents divided by 1 plus 0.2 to the power of 2. Okay, so from 2 onwards, I have to put the power there. I have to raise it to the power of 2, and then it gives me an answer of 5 rand 80 cents. Okay, and for period 3, I do the exact same thing. 9 rand 86 cents divided by 1 plus 0.20 to the power of 3, because I'm in year 3, and it gives me a dividend of 5 rand 70 cents. That is what it's worth today. Okay, now I also need to discount the market price per share at year 3. Okay, so remember that's at year 3 as well. So I'm going to take the 81 rand 16 cents, which is what we got here, divided by 1 plus 0.20 to the power of 3. Okay, and it gives me 46 rand 97 cents. So I've discounted all the dividends as well as the market price per share at year 3 to today's value. Okay, so now we do the last step. What is the last step? We just add all these discounted cash flows together and we will get the current market price per share. Here it is. P0, which is the current market price of a share, which we are asked to calculate what the investors would be willing to pay for the share. So it's going to be all these discounted cash flows added together, like I said. So it's 5 rand 90 plus 5 rand 80 plus 5 rand 70 plus 46 rand 97 cents, and it will give us the current market price of a share of 64 rand 37 cents. Okay, I hope this example has made sense. You follow the 4 steps. First step is to calculate the dividends for all the years in the supernormal period. Okay, that is the one with the high growth rate, which is at 18% for the first 3 years. And then the second step is to calculate the market price per share of the final year of the supernormal period, which is the 3rd year. Okay, and then the third step is to discount all those cash flows, all the answers that you've gotten to today's value, and you see how we do it here. You can see the formula we used. Okay, and then the fourth step is to add all the discounted cash flows, and then you'll get the current market price per share. Okay, so let's quickly look at the second example here. What I would want you to do is to pause the video here and try and attempt this question yourself and gauge if you understand what we've been going through in this lesson. And then you can continue the video and watch how we do the answer ourselves. Okay, so you'll be a bit quicker with this one because we went through the first example in more detail. Okay, so where's our formula? Here's our formula again. P0 equals to D1 divided by KE minus G, and D1 we get it by taking D0 times 1 plus G. So what are we told here? We are told that what is the price of a share which last paid a dividend of 10 rand per share and is expected to grow at 25% per annum for the next 4 years, after which it will have constant growth rate of 10% per annum. The investors requires 30% for a share of the same risk. Okay, so what is our supernormal period? Well, it's 4 years. So we have 4 years in the supernormal period because the high growth rate is 25% for the next 4 years, after which it will have a constant rate of 10% per annum. So what I know is that the first step is to calculate the dividend per year for the next 4 years. So I'll calculate the dividend at period 1, period 2, period 3, period 4, and then I'll also calculate the market price per share at the final period of the supernormal period, okay, which is the market price per share at year 4, and then I will discount all the cash flows as the third step, and then I will add all those discounted cash flows together to get the current market price per share. So what is the dividend at period 1? Well, here's the formula. Period 1 equals to D0, which we are given. It last paid a dividend of 10 rand, so we're going to have 10 rand, and then times 1 plus G. What is the growth rate? It's a 25%. So it's 1 plus 0.25, which we get by taking 25 divided by 100. So here it is, dividend at period 1, 10 times 1 plus 0.25, and it gives us a dividend at period 1 of 12 rand 50 cents. Okay, and what is the dividend at period 2? Well, we take the dividend at period 1, which is the 12 rand 50 cents, times 1 plus 0.25, and there it is, and it gives us an answer of 15 rand 63 cents. And for the third year, we'll take the dividend at period 2, which is the 15 rand 63 cents, times 1 plus 0.25, and it gives us a dividend at year 3 of 19 rand 53 cents. Okay, and period 4, we take the 19 rand 53 cents times 1 plus 0.25, and it gives us a dividend at period 4 of 24 rand 41 cents. Okay, so I've calculated all the dividends for the supernormal period. Now we move to the second step of calculating the market price per share at period 4. Okay, I hope you attempted the question and you know how we'll calculate the market price per share at period 4. What are we going to do? We're going to take the dividend at period 5 divided by the required rate of return minus the new growth rate. Okay, so here it is. The market price at period 4 equals the dividend at year 5 divided by the KE, which is the required rate of return, which is the 30%. So it's 0.3 minus the growth rate. Which growth rate are we using? We're using the constant growth rate of 10%. I hope you got that one correctly. Students usually make the mistake of using the growth rate during the supernormal period, which is the 25%, which is incorrect. You have to use the new growth rate where it becomes constant. Okay, so it's the 0.3 required rate of return minus the new growth rate of 10%, 0.1. Okay, so how do we get the D5? Well, we're going to take D4 times 1 plus the new growth rate of 10%. So D4, we already calculated it, 24 and 41 cents times 1 plus 0.1, which is the constant growth rate after year 4. Okay, now that is how it looks, and it gives us an answer of 26 rand 86 cents. That is the dividend at period 5. Now that we have that, we can get the market price per share at year 4. Okay, so we'll take this 26 rand 86 cents, okay, divided by KE, which is the 0.3 minus the 0.1, and there we go. 26 rand 86 cents divided by 0.3, which is the required rate of return, minus the constant growth rate after year 4 of 0.1 or 10%, and it gives us an answer of 134 rand 28 cents. That is the market price per share at year 4. Okay, so we've just done the second step. The third step is to discount all these cash flows to today's value. Okay, I hope you remember the formula. So we're going to discount the one at year 1, and remember we discount it using the required rate of return. So we're going to take for period 1, the dividend at period 1, we're going to take 12 rand 50 divided by 1 plus 0.3. Okay, so there we go, 12 rand 50 divided by 1 plus 0.3. And remember, it's to the power of 1. We don't have to put to the power of 1, because even if you put to the power of 1, it's still going to give you the same answer, 9 rand 62 cents. And for year 2, we're going to take the dividend at year 2, 15 rand 63 cents, divided by 1 plus 0.3 to the power of 2, because we are in year 2, and it gives us 9 rand 25 cents. Year 3, we do the exact same thing. The only thing that changes is to the power of 3, and you take the cash flow or the dividend at year 3 of 19 rand 53 cents, and we divide it by 1 plus 0.3 to the power of 3, and it gives us an answer of 8 rand 89 cents. Year 4, we take the 24 rand 41 cents, divide by 1 plus 0.3 to the power of 4, because we are in year 4, and it gives us a discounted cash flow of 8 rand 55 cents. And then the market price per share at year 4, we also need to discount it to today's value. So we're going to take the 134 rand 28 cents divided by 1 plus 0.3 to the power of 4, because it's in year 4 as well, and it gives us a discounted market price per share of 47 rand 2 cents. Okay, so we've just completed step 3. Step 4, we just add all of these discounted cash flows together, and it will give us the current market price per share, which is 83 rand 33 cents. Okay, so we added all of them together, and that is the answer that it gave us. I hope you attempted the question, and I hope after you attempted it and you've seen how we've done it, you were able to get the same answer. If not, you can go back and rewatch the first example or the second example or both, and you should be able to understand how to get the current market price per share using the dividend growth model, the non-constant dividend growth. Okay. Okay, and I hope this lesson has made sense. And if it has, and you have gained value from this lesson, please subscribe to our channel, like this video, and share it to those who think it might help. Till next time, cheers.